not only has China in particular drained the West of its physical gold, but also she's now setting up the market to replace the paper markets in London and New York. And if you look at the contracts, the contracts in gold basically are paper contracts. They're dollar contracts. They're not gold contracts. They're dollar contracts which refer to gold. Why? Because the whole object of the exercise of anyone dealing is we will deal in fiat dollars or fiat sterling or fiat euros, if you like. But it's basically a paper currency market. And so China is, if you like, replacing that in Hong Kong. And for the first time certainly since post-Mao days, for the first time, she's now permitting citizens to export gold from China to Hong Kong without having to get the permission of the People's Bank in order to do so.
Global financial architectures are undergoing a dramatic structural transition as Western fiat currencies face mounting structural strains. Physical gold is rapidly re-emerging as the premier anchor for international trade settlement and central bank reserves. Alasdair Macleod, a well-known economist, author, and financial commentator, emphasizes that Eastern powers are strategically preparing for the ultimate collapse of Western paper currency systems. Looking ahead, China is predicted to place the yuan on a formal gold standard once Western market failure becomes undeniable, while the United Kingdom will likely introduce strict price controls later this year to combat inflation. Furthermore, regional Middle Eastern blockades following mid-August are projected to trigger severe global stagflation, forcing the U.S. Treasury to fund deficits through short-term T-bill issuance. This rapid debt expansion will erode dollar purchasing power, ultimately compelling foreign investors to liquidate roughly $25 trillion in U.S. paper assets as commercial banks dump collateral into a collapsing market. Now, we present the clips from Alasdair Macleod's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
That China has so obviously been planning to have its own secure replacement as a currency compared with the fiat currencies in the West.
Yes.
Back in February, she told her banks, sell US Treasuries. And not only that, but she's developed, not only has China in particular drained the West of its physical gold, but also she's now setting up the market to replace the paper markets in London and New York. And if you look at the contracts, the contracts in gold basically are paper contracts. They're dollar contracts. They're not gold contracts. They're dollar contracts which refer to gold. Why? Because the whole object of the exercise of anyone dealing is we will deal in fiat dollars or fiat sterling or fiat euros, if you like. But it's basically a paper currency market. And so China is, if you like, replacing that in Hong Kong. And for the first time certainly since post-Mao days, for the first time, she's now permitting citizens to export gold from China to Hong Kong without having to get the permission of the People's Bank in order to do so. Obviously, she's freeing up movement of gold in the context of the yuan eventually being a gold substitute. In other words, put on a gold standard. And she will, basically China won't do this until it is absolutely obvious that the Western currency system is failing. In other words, the signal that she will send to the markets is she is protecting herself from our follies.
Yes.
She doesn't want to precipitate the collapse in our fiat currencies, where she's been very, very careful how she moves. She doesn't want to get blamed, if you like, for collapsing our currencies and economies. She will just appear to protect herself. And Russia is the same. Russia can do exactly the same. You read our press, you'd think the Russian economy is an absolute mess. It's not. Actually, It's stronger than ours.
Yes, exactly. That's what I've noticed. It's quite surprising. Well, it's kind of surprising, kind of not. They've been doing well for quite some time.
Well, they've been doing well because they've had particularly the energy exports which have been the mainstay of government financing. I mean, the debt to GDP, government debt to GDP in Russia is 18%. The one thing that is difficult is that the interest rate level is high, very, very high, because the inflation rate has been high. I mean, we had a sort of fair collapse in the purchasing, well, if you like, in the exchange rate for the ruble when Russia invaded started this SMO back in 2022, February 22, I think it was. If you remember, the ruble went up because, again, like the yen, it's an upside down rate. But it went up to, I think, about 120 to the dollar or something like that. It's currently sitting, I think, sort of 70, 80 or something. It has been like that for some time. The Central Bank of Russia has maintained high rates, and I think its current indication rate is around about 14%. Right. But in a sense, it's actually sort of worked because, people got used to it. That's the first thing. They don't have a lot of private sector debt. And there's been pretty high employment in Russia, apart from in the army. And wages. I mean, wages were rising at something like 30-odd%, while prices were rising at about 10%. Wow. The result is that people have been able to save or improve their living standards quite significantly under President Putin, despite this extraordinary situation of having, interest rates running at sort of 14 up to 25%.
Incredible.
It is an amazing situation, yeah. And if you don't believe what we're saying, then take out an insurance policy. Buy a little bit of gold if you like, because by God, you'll need it. But my view for some time has been just get the hell out of credit. Don't try and trade it. I mean, I'm sure that there were people who seen gold or seen silver fall from, the January, February highs and say, oh, I told you so. And they'll be out of it. And, when there's when gold is £1 million an ounce and a pound doesn't even buy you, half a tube of polos. Well, that's already the case, isn't it? Yes. When £1 million doesn't buy you a coffee, you begin to think, well, I should have listened, shouldn't I?
Yes, exactly.
But I mean, the reality of these currency collapses, Jasmine, is that it is always the users of the currency who are last to understand it. They think that its price is rising. They don't understand it's the currency falling. Mm-hmm. That's the key thing. Yeah. Eventually, it gets to a point where they do understand it. And then the currency's probably got anything between 3 and 6 months left because people will be dumping the currency to buy things because they don't want to hold on to falling currency. Yeah. But they only realize this very, very late on in the game. Yeah. And that's always been the experience when you've moved from sort of relative currency stability to, prices beginning to rise and beginning to rise and beginning to rise, and then the rise accelerating and all the rest of it. And you blame, the other thing we'll get in the UK, I'm sure, with our wonderful new chancellor, is we will get price controls. He's already said to the supermarkets, don't you dare price gouge, Yeah. And that to me is someone who, he plays politics. But I think he will introduce price controls, probably later on this year.
The foundation of Western financial markets rests heavily on paper-based leverage rather than tangible value. Gold trading in London and New York consists primarily of fiat dollar contracts that merely reference precious metals rather than delivering physical gold. In stark contrast, Eastern financial centers are actively transforming trading infrastructure by removing central bank restrictions on physical gold transfers to Hong Kong. By draining physical reserves directly from Western vaults, these moves shift pricing power away from paper derivatives toward physical bullion. Meanwhile, average currency users consistently fail to recognize that rising consumer prices stem from the underlying depreciation of fiat money itself. When citizens finally realize their currency is losing value, panic selling ensues, rapidly accelerating monetary failure within months as people rush to exchange credit for physical goods. Now, let's get back to the interview.
The Bank of Japan will be under pressure to raise its interest rates even further, above a horrific 1%. The Japanese Finance Ministry, which asked its pension funds to invest more in Japanese debt, guess what? They have to sell foreign debt in order to do so. And also, guess what? The insurance companies, the returns I've seen, they have been liquidating their foreign investment assets as well. Well, I think it's going to be returned to that. Japan is in trouble. This is what we're seeing, actually. I mean, you and I can readily identify the problems that Japan has, which, I've been talking through, and it's not a surprise to you, I can see from your reaction. But the other thing that's been exposed by this problem is that it's absolutely clear that the US Treasury knows it has a problem. Yeah, that's the other side of it. Think on this. We get higher we get higher inflation, as they call it, which basically means that the dollar loses its purchasing power. So bond yields have to rise above that 5% level. You have got the consequences of Hormuz and now the Red Sea being closed off. This is not going to end soon. There's not a magic wand going to be waved. That's not going to happen. They will be closed until basically the US economy collapses. That's the way the Iranians look at it. And everybody I talk to who have knowledge, if you like, of the Iranian situation, they're starting to mention a word, revenge. They want revenge against the great Satan and also against Israel. So this is something which is pausing. We've got a 60-day pause, which incidentally ends on October the 16th. So, all that Iran has been doing is that when they've been bombed by America, they have retaliated against American bases. They haven't touched Israel. They have, in this sense, respected the 60-day pause. That ends in the middle of this month, on the 16th of August. I think it'll probably kick off after that. And I think they will probably attack Israel this time as well. God. So this is going to get worse. On that basis, you're going to see reflected in consumer prices, you're going to see, two things. The private sector is going to go into a slump. And the second thing is you're going to see prices really rising. Call it the worst situation of stagflation you can possibly imagine. What do governments do? They want to borrow money because they've got to go and support their economies. They've got to support their financial markets. You ain't seen nothing yet in terms of what they borrow, but they're running into a brick wall in terms of debt.
Yes.
They can't actually raise any more. So how is this going to play out? Well, the answer basically is that their financing is just going to get shorter term. And you're going to end up with the US Treasury basically the equivalent of printing money, because the debt on the other side will be, sort of 1 month T-bills and not much longer, because they can't afford. They can suppress the interest rate, but they can't actually manage the longer term rate because there won't be any buyers in the longer term. So forget about anything with maturing in more than 5 years, more than 2 years, possibly. And under those circumstances, your money printing is going to have on the other side of the balance sheet just shorter term obligations. So what happens to the purchasing power of the dollar? Well, it's a crisis. It's not going to actually, they can't stop it happening. And if you look at the makeup of the equity market, there is foreign interest in the equity market on the last Treasury international capital system, the tick figures, was registered at, I think it was just under $25 trillion. $25 trillion of foreign investors hold US treasuries. Now, we know what happens in a crisis. You sell all the foreign stuff.
Yes.
That's going to be liquidated. It's going to be liquidated in an unwilling market because at the same time, one way and another, the banking system has collateral or collateralized roughly $9 trillion of debt directly through hedge funds and also through broker loans. They're going to be covering their, if you like, their assets. They're going to try and secure their loans by basically selling their debt into a falling market. This is what was identified by Irving Fisher in the 1929 to 32 bear market as to why it was so severe. Banks were having to liquidate debt positions by selling the collateral into a falling market.
Despite persistent media assertions that Eastern economies are in distress, underlying financial metrics reveal surprising structural resilience. Russia, for instance, maintains a remarkably low government debt to GDP ratio of just 18%, anchored firmly by vital energy exports that sustain state revenues. Even while managing elevated central bank interest rates around 14%, strong employment and wage growth exceeding price inflation have enabled domestic savings to grow without heavy reliance on private credit. In stark contrast, sovereign debt markets across developed nations are experiencing severe strain from escalating interest burdens and foreign capital flight. Japanese pension funds and insurance companies are actively liquidating foreign investment assets to finance domestic debt obligations, reducing international demand for Western paper. Meanwhile, commercial banking networks have collateralized approximately $9 trillion in debt tied to hedge funds and market intermediaries. As systemic risks multiply across global credit markets, holding physical bullion remains the primary mechanism for preserving capital against the ongoing degradation of unbacked fiat currencies. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.